That's the theme of today's call, retirement-focused tax law changes. And my name's Lyman Jackson. I'm one of the partners here at Financial Planning Solutions, along with Rick Fingerman. And we have the rest of our staff on the call here. Janet Friedman is also here, along with Dylan Driscoll and Andrew Holmes. So that's the team.
And the world famous Maggie.
And
Right,
I'm sorry, forgot the most important person who keeps all the wheels turning,
right.
Maggie Dolan.
Yes.
So before we get started, we always have some interesting, fascinating compliance uh, sentences to read off, and I'll get through those as quick as I can. This webinar is for educational purposes only and is general in nature. If you have questions about your individual accounts or investing holdings, please contact your advisor directly. The firm only renders investment advice to clients that have signed an advisory agreement with Financial Planning Solutions. So today's update to kick off the conversation is going to be covering these three areas that were new changes as a result of the passing of the One Big Beautiful Bill that was signed in January into law. Many of these things are effective this year. Some things are going to be effective next year, but we'll go through all of that with you today. And starting off with the first section, senior deductions, is Rick. Take it away, Rick.
All right. So what does all this means? Well, there's been an additional $6,000 deduction for seniors that's 65 or older, and that gets doubled if you're a married couple filing jointly to 12,000. You got to be 65 or older, and it's only for tax years 25 to 28. And the unique thing is it's available to people that file the standard deduction or itemize, but there are income limits. So there are phase outs if someone's modified adjusted gross income, if you're single, is over 75,000, the phase out start. And if you're married filing jointly, it's 150,000. And the phase outs are the deduction is fully phased out if it's over $175,000 if you file as a single person, or 250,000 if you're joint. So some people thought that this one big beautiful bill, we were told at one point, was going to eliminate the tax on Social Security, but that is not really true. However, there are many seniors that might see a reduction or elimination on taxes on their Social Security benefits, which can be taxed up to 85%. So again, everybody's situation is different. We look at our clients very closely when it comes to all this stuff to see where there's some opportunities to minimize taxes, and we'll talk about some potential things to do a little further along. But I'm going to turn it over to Andrew, and then we'll be back.
Thanks, Rick. And I'll
Sure.
say too, yeah, we're open. If you have questions throughout the presentation, feel free to add them to the chat box. And at the end, we'll also have an ended piece, I guess, where you can voice your questions there as well too. Um, But as far as, I guess, just changes to the standard and itemized deductions, so I guess the way to kind of think about this from a standard deduction perspective, it's really just an extension of the current tax law. So the brackets are going to stay relatively the same. There's, slight adjustments in there for inflation that you'll see between the chart on the left-hand side is kind of the current, and then the proposed, or I guess the new law is in the green on the right-hand side. So you'll see on the standard deduction, it's a slight inflationary difference moving into next year. But some of the bigger changes that we'll see, oh, sorry. The bigger changes that we'll see with the bill will be more so on the itemized deduction side. There's been a lot of talk about SALT taxes. So those are just, classic tax term that's an abbreviation for state and local taxes. But think about this in terms of, a lot of our clients are in some of these higher cost of living areas, if you're Newton, Weston, areas like that where real estate taxes can exceed $10,000 pretty easily. That SALT cap really kind of put a damper on your ability to itemize previously. The new cap is $40,000, but there are, income reductions on that too. So if you make over $400,000 a year, there are phase outs in your ability to actually deduct up to that $40,000 mark. With interest rates as high as they are, we do see a lot of our clients that if they have mortgages, um, and then they've or for homes they've purchased in the last couple of years, mortgage interest is still deductible up to $750,000. So that can be substantial as a way to kind of get you to itemize deductions as opposed to the standard deduction. I guess for background on that too, generally if your itemized deductions add up to more than that standard deduction amount, so if like totaling together these boxes in the bottom right and it exceeds these boxes and I guess the top right as far as the single or married filing jointly, that's where you would pursue some of these itemized deduction areas. So the other buckets outside of the mortgage interest and the state and local taxes are things like charitable deductions and donations here. It's a little tidbit here with this floor, but basically they're chopping off a little bit of your ability to deduct those charitable amounts if you itemize. And then the last thing is that uniform 2% limitation. That's really only going to affect our clients that are in the highest tax bracket. So that means that you have income over $600,000 a year. But it's something that it can exist if maybe you're a small business owner or something along those lines, and if there's a business sale or something crazy, that's abnormal that can push you into a high tax bracket, that's an area where in the new tax law, even if you're in the 37% tax bracket, you have charitable deductions, they're going to cap you at 35%. So Rick has some ideas a little bit later on too, as far as how we're thinking about things, especially on the charitable side, planning wise with some of these changes. But I'm going to lead this off now to Janet to talk a little bit more about the additional charitable deduction.
Thanks, Andrew. Hello, everyone. I'm Janet Rhodes Friedman. Just a quick highlight of a fairly big change. Currently, in this tax year, 2025, if you take the standard deduction, there is no deduction for your charitable giving. The only way you're able in this tax year to get a deduction for your charitable deductions is if you itemize. So Andrew just went through the chart in the previous slide that showed if you itemize and you're above those you have to be above those thresholds. But beginning in 2026 and beyond, you will be able to deduct $1,000 as a single taxpayer or up to $2,000 as a couple if you make charitable donations. And that's regardless of whether you take the standard deduction or whether you take whether you itemize. So that's kind of a big deal for many people who want to give to charity, and they want to give to charity regardless of getting a deduction, but this is like an added incentive that they'll be able to donate with a tax deduction going forward. And I will now turn it back to Rick Fingerman. Thank you.
Thank you, Janet. So really there's three areas we're going to touch on: Roth conversions, donor advised funds, and that lovely topic that we all love is that Medicare IRMA planning. That IRMA stands for Income Related Monthly Adjustment Amount. It's really a surcharge. But let's talk about Roth conversions first. So just as a quick little, primer. So a Roth IRA is different than a regular IRA. Roth money goes in, you don't get a tax deduction, but it goes tax-free and it comes out tax-free down the road. Some people can't do a Roth contribution because their income's too high, but you can do a Roth conversion at any income. And what we look at when we look at client situations is we like to pick Roth conversion years where someone's income isn't super high, because then they're in a higher tax bracket. Anything that you convert is taxable income in that year. So in 2025, if you do a Roth conversion for $100,000, it's like you're making $100,000. You also have to have money someplace to pay for the conversion. So with these new rules, especially if somebody is 65 plus, from 25 to 28, it might be a good opportunity to do these conversions because it might reduce your total taxable issue. So that 6,000 per person or 12,000 per couple could be really a good time to look more closely at doing a conversion. And we can help you figure all that out, especially working with your CPA. Donor advised funds is a way for someone to make a charitable contribution. And it doesn't have to be today. You make the contribution into a donor advised fund or DAF today. And the reason that people do that is, number one, they're charitably inclined, but it can also be really a great tax strategy because you can donate a huge amount of money in 1 year and get a deduction in that 1 year. Now, with the higher deductions and on top of the senior deduction, a lot of people might not make sense to itemize. It might make more sense to do the standard deduction. And as Janet pointed out, there's a limitation on making a deduction charitably if you're not itemizing. So one strategy could be if you're charitably inclined, because once you put money in a donor advised fund, you can't take it back. It's really a gift to a charity. And that money can stay in this donor advised fund for 30 years without giving it to a charity. You can give it right away, give it to multiple charities. It's pretty flexible. We can talk more about that. And I think with this new one big beautiful bill thing, these might become even more popular. So basically, you put money in there, you get the big deduction, and then in future years, you would potentially itemize, take the standard deduction and get that senior deduction with the standard deduction because you've already made that, you've kind of lumped your gifts in that first year. So for example, if you give to a charity like $5,000 a year, you could put $50,000 in there and dole out $5,000 a year from the donor advised fund, even though you made that one contribution that one year. And then from 26 to 28, you could just take the standard deduction and potentially, save some money that way. So again, everybody's different. We have to kind of look at it all. And the last lovely topic is this Medicare planning, which we look at a lot. Sometimes we can do stuff, sometimes there's not much we can do, but it's basically a surcharge, this IRMA, on parts B and D. If you're collecting Social Security, not collecting Social Security, if you're on Medicare, Part A is generally free. Part B, the lowest you're going to pay is $185. But if your income's above certain limits, there are all these brackets where they hit you with this surcharge. So it's not ideal. If your modified adjusted gross income, I think, is below 106,025, there is no IRMA, and 212,000 if you're married filing jointly. There's no IRMA issues. But if it's over that, then you're in these different brackets. So what Medicare does is it looks back 2 years. So in 2025, it looks at your 23 taxes to determine if you have to pay that surcharge. So the one big beautiful bill is not going to really do anything to eliminate this problem, but we do what we can do. So if somebody is retired this year or next year, somebody is divorced this year, somebody becomes a widow this year or next year, those are qualifying events. And we've helped a few clients submit some paperwork to eliminate this IRMA issue. So if any of those fit you, it's a good time to let us know so we can try to reduce or eliminate this IRMA problem. So there's a lot that we can talk about IRMA and Medicare, Roth conversions, and donor advised funds. If any of these things kind of pique your interest, reach out to us. We're happy to walk through it in more detail specific to you. I'm going to turn this over to Dylan to wrap things up.
Sure. So just some key dates to watch out for coming up on September. So on September 11th, we get some inflation data with the CPI report for the month of August. And then on September 17th, there's going to be a lot of eyes on the Federal Reserve meeting to see whether or not they cut interest rates or not, or if they keep them steady. And then the next Federal Reserve meeting after that will be on October 29th. And then so just a quick summary of what we chatted about today regarding the new tax law changes. So there's that addition of the senior deduction for those 65 and older, the updated standard and itemized deduction limits, as well as the additional charitable deduction. So if you guys have any questions, feel free to put those in the chat box, or you can just voice your questions as well.
Anyone? Maybe everybody fell asleep.
No, we're not.
Wow.
Oh, okay.
It's a lot of information to absorb.
It's a lot of stuff.
Yeah.
And
And I
there's a
didn't-
lot that I'll admit I've not read this bill in entirety. I did a lot of skimming but there's a lot in there and a lot doesn't really apply to our clients, but some of it, can be helpful. The senior deduction, if your income allows, you might not get the full 6,000, you might only get 2,000, but it's something and it could help a little bit.
Yep.
We have a question from Nancy.
Let's see.
Yeah, so thank you for this.
Hey,
I
Nancy.
guess I'm just concerned, everything changes every 5 seconds, it seems. So, like, if we were to put money into this donor advised funds, which sounds really nice, what's to say it's not going to change in 2 years and then we're kind of stuck with some big tax liability? Any guidance on what's happened in the past? Thanks.
Yeah, well, the donor advised fund isn't really related to any kind of legislation with who's in office today. The
Okay.
rules set up for that are pretty strict. If you put money in a donor advised fund, it's held in an institution, and the rules are basically once that money goes in, you get the tax deduction, and the money has to go to a qualified charity. You can't take it back, you can't give it to your kids, but it's a way to lower income, especially if someone has a high income year and they want to try to offset some of that income. Or if they're just charitably inclined and they want a different vehicle that kind of makes it easy where, all this money is sitting in this account growing. You could leave it there for 30 years invested, potentially to let it grow, and then you'd leave more money to a charity. Or you can dole it out as you see fit each year, or you could skip years. You could do multiple charities. So it's pretty flexible. The only thing we've run up against, Maggie and I've done some of these where a client wants to donate like $25 to a charity, and sometimes there's a limit, depending on the donor advised fund, that it's got to be at least $250 or something like that. Is that right, Maggie?
Yeah, that's correct.
Yeah.
There are some limits there, and there is also an administrative fee that you pay that donor advise the management company of the donor advised fund.
Yeah. And it can be minimal or depends on which one you go with, but
Okay. Thanks for
yeah.
that.
So
And sorry, Rick, did you say that you can take the tax deduction in the year that you put all that money in there, or you take
that
it when you dole it out? Okay.
no, it's
Thanks.
when you actually put the money in. So, for an
Brilliant.
example, we
Okay.
might add a client that got a $200,000, bonus at work. They established a donor advised fund, they put money in there, for an example, to kind of offset that big bonus to keep them out of the next tax bracket.
Hmm.
And then that money just sits there and goes to whatever charities they want down the road.
Nice. Okay.
Yeah.
Thanks.
But it really only helps you to spread out your donation over many years.
Well, you could actually make the donation in 1 year. But
I
you probably
know,
don't need the donor advised fund to do that.
right. That's what
Yeah,
I'm saying, is if
yeah,
you just want to give the money, you could just do it as a charitable deduction that year. But this
sure.
allows the organizations you're sponsoring to get a steady stream of income, or a steadier, at least, by allowing you to take the big deduction 1 year and then feed it to them incrementally over a period of time.
Right.
Okay.
And you also have, while it's in the donor advised fund, those assets can be growing. So instead of giving
Like tax free.
25,000 to one charity 1 year, that could be 40,000 that you could split up. That it also has that growth capability.
So which kind of funds have donor advised funds? I mean, these are with all sorts of different companies that will have the funds that you could put it in there.
Yeah, I
Like,
mean, there's major players in this market that oversee these donor advised funds, and they all have an investment option in there. Could be
yeah,
basically invest in anything you want for the most part. So you could lose money as well, and that means the charity would get less. And I'm
okay,
sure charities would rather have money today, since they don't pay any taxes, than tomorrow or 20 years.
right,
But if you're set on giving, a charity, let's say $1,000 a year, that's just what you've always done. You can just keep doing that. Just give $1,000 a year, $1,000 a year, and you could also, if you didn't like that charity 5 years from now, you could switch to a different charity.
right. Okay.
Just to jump in here, one thing that we haven't talked about with the donor advised fund that's a big advantage for some clients is if you have highly appreciated
Right.
securities, those are an excellent candidate to contribute to a donor advised fund. In other words, if you were to sell those and incur a big capital gain and then make your donation, you'd actually be, you could avoid the capital gain altogether if you just transferred it into a donor advised fund and then made the donation to the charity.
Yep, which makes it a lot more powerful. As a matter of fact, I think most donor advised funds we've done has been with appreciated assets. Someone's got stock or mutual funds they've had for a long time, and we use that money versus cash, usually.
It gives you the flexibility then of deciding who to give your charitable gift to in the future. You don't have to make that decision now. So you put it, you have given it, but you haven't given it to anybody specific yet. Okay, gotcha.
Right.
Yeah, like if you gave 50,000 and you were going to just give it directly to the Jimmy Fund, you're stuck. If they have it, you can't do anything about it. But if you're just going to give them 5,000 a year, you could make a change a few years down the road and say, yeah, I think I'm going to switch it to this charity instead. Or
Right. Okay.
they cured cancer and they don't need it anymore. Or, yeah. So we have another question. Any change in using RMD toward charitable contribution? So those are called QCDs, qualified charitable deductions. So once everybody in this room, if you have an IRA, 401k, 403b, one of those pre-tax type accounts, is subject to these required minimum distributions, generally from age 73. You're born after 1960, it's age 75, and you've got to take these distributions out. That's one reason some people do Roth conversions with some of their money to minimize what those required distributions are, because 100% of those distributions are taxed as ordinary income. So one thing people could do is if it's either it's their own IRA or an inherited IRA, they can donate that required distribution to a charity instead. You've got to be at least 70 and a half to do that if it's going to go to a charity. It has to go directly to charity before you take any difference in your required distribution. So what I mean by that is if your required distribution is 50,000 and you give 25,000 to a charity through this QCD, you've got to do that first before you take the remaining 25 yourself. And it has to go directly to the charity. So we make sure that's done right, or Maggie does, for our clients, so there's no IRS problems. But you've got to be at least 70 and a half to do that. But there's been no other changes in that with this one big, beautiful bill.
So it still has to be an IRA. You can't do it out of your 403b or anything.
No, I believe you can. But you've got to be at least 70 and a half.
Yeah, I got that by a few years.
Yeah.
But no, I didn't realize that. I thought that only the IRA MRDs were qualified. I didn't think you could do it from a 403b or.
I double check that, but
I don't believe you can. I think it has to come out of an IRA.
It has to be the IRA. I thought you could. Okay.
Right. And the Roths are IRAs, aren't they?
They are, but you would not use a QCD or qualified charitable. You wouldn't make one out of a Roth because that is a different tax situation.
Exactly, that's true.
Which I see that earlier we had a question from Mark about any changes to the Roth rules. And I'm not aware of any significant changes in the tax bill that was passed this summer pertaining to Roth.
No.
I'll put that out to the rest of the team.
Nope, I don't think so.
No, I think it's really so. I mean, Rick kind of touched on like inherited Roth IRAs. I mean, that was a change, I guess, with the Secure Act 2.0, where they kind of talked about that money has to come out within 10 years, but traditional Roths, no changes there in terms of implications.
And that's for inherited accounts that were for Roth or for regular, but that was after 2020. So if somebody passed away before that, they're still grandfathered into that stretch IRA where they can take it out over their lifetimes. So I think it's a better way to go than 10 years personally. But if you have a Roth IRA that you inherited, there's really no benefit to take that, if you don't need the money, to take that out before the 10th year. You might as well just let it go tax-free because there's no RMD, required minimum distribution, and
right. You've already paid the taxes on it, right? Their philosophy.
Yeah. Or
on the principal, at least. You haven't paid the taxes on the interest, which is the big plus. You won't have to.
Right.
Breaking news just in. Donald Trump has made it official. A brand new round of Social Security payments is on the way starting the 20th of August. Here's how it breaks down. No extra forms, no waiting lines, payment.
Where's this coming from?
What's that?
Yeah, what is that all about?
I want to follow up on the QCD question. They are only allowed from an IRA,
Okay.
but you can take your 401k and roll it into an IRA,
Yeah.
right? And then do a QCD. So if you only have a 403b or 401k plan, you're not, there is a way to do this. It's just an extra step. Okay. So I just want to
Yeah. And,
mention
generally
that.
because we aren't overseeing 403 or 401k plans, unless, we've established them for people, we're working with IRAs here for the most part because we've consolidated things. And yeah.
Well, I'll find out later. I'll talk with Janet about the issue of rolling over and what, if any, penalties there are of rolling it from a 403b to an IRA, just so that we can then not have a taxable MRD from the 403b that's quite so big.
Yeah.
Right.
Yeah. We'll talk about it offline. Okay.
Yep.
Thanks, John.
Mm-hmm.
All right.
Okay.
So if there's no more questions, if you guys think of any questions later, feel free to contact your advisor or Maggie or myself, and we'd be happy to help you out. And our next call for the month of September is on Tuesday, September 30th at 4 p.m.
One question comes up. Do you always record these sessions for
Not
later?
always.
Only if we think of it.
Okay. The reason is I probably would have done that today just because we were on our way to someplace and I delayed our trip so I could listen to this first one. But had I known it would be recorded, then I could have just skipped it and then asked Janet or somebody to send me a link to it so I could play it back and hear what you had to say. Okay.
We can do that going forward. And if you have any
Yeah.
questions for September 30th and you're not around, just send them to, Janet ahead of time and we'll make sure we answer them.
Okay. Sounds good. Thank you.
Okay.
Thank you, everyone.
Thanks.
Thanks,
Bye.
guys.
Good evening.
Bye.
So long, everybody.
Bye-bye.